No one on Wall Street expects a bad 2025. That's not hyperbole. Least bullish target 6,400 by year end for the S&P. At the higher end, we've got 7K, 7,100 from Oppenheimer. Let's play devil's advocate in this video. We'll entertain the idea that stocks could vastly underperform these estimates. Hey guys, Brian here. I write the European financial forecast at Elliott Wave International, but we're going to focus on US markets for the moment, partly due to this graphic that's been making the rounds. I came across it in Howard Marks' latest memo. If you don't know Marks, co-founder of Oaktree, very influential investor, author, probably most widely known for these investment memos. His latest on Jan 7 discussed this graphic. It looks complicated, but it's super easy. Each square here represents 1 month, and we're looking at every month between 1998 and late 2014. So it's a 27-year time span, 300 plus data points showing the forward PE ratio in the S&P for that month plotted against the annualized return in the S&P over the next 10 years. So the trend here is not surprising, right? Investing at a higher starting valuation leads to lower returns. And Marx, of course, points out today's valuation, we're sitting close to 23 times earnings. In the past, at least since 98, your 10-year return, if you bought the S&P near today's valuations, your return was a pretty measly plus or minus 2%. So regardless of what you think will happen in the S&P in 2025, valuation should be at least a little worrisome here, given that you can buy a 10-year treasury and get close to 5%. So is this chart a guarantee of the future? Of course not. The sample size is small in relation to market history. 98 was also close to the beginning of a period of significant market weakness. But I just want everyone to keep this chart in mind as we look at a couple more graphs here. So what about those forecasts for 2025? This chart here looks at the sentiment among small traders, right? These are retail investors. It's the ratio of total put premiums to call premiums, 10 contracts or less. So we're trying to isolate here small retail traders, and they're wildly optimistic. No surprise, their ratio just hit 0.32. So bullish bets essentially 3 times the level of bearish bets. That happens to be the most lopsided since November of 2021, after which we saw an 11-month 38% drawdown in the NASDAQ 100. So trader optimism harking back to prior market tops. Now, final chart, what about the professionals? Well, we can get a sense of their positioning by looking at the allocation to stocks of U.S. pension funds. Equity allocation today is north of 80% of total assets. And the long-term history here is pretty interesting. If we go all the way back to February 1966, pension managers were about 55% in equities, and they moved to a then record 68% in the first quarter of 72. That 66 to 72 period, that's important because it was a topping process in the Dow. It was a cycle degree wave 3. That topping process generated the biggest bear market since the Great Depression. So pension fund managers, even the experts, they were pushing money into equities right at the time of a major top. In a perfect world, this graph would be inverted. Fund managers would be drawing down their equity allocation at market tops to have the cash on hand when stocks get cheap. They didn't do it then, and they're definitely not doing it now. Of course, none of this is a near-term timing tool. We use Elliott Waves for that, but given the wildly optimistic projections for this year, I just want everyone to have some perspective here. The professionals and the amateurs wildly bullish, both in the near term and the long term. All of this is happening in the context of a overvalued market that bodes poorly for longer term returns. Thanks for watching. If you enjoy this type of content, hit the like button, subscribe to the channel. I'll put up links in the description if you'd like to subscribe to our full services. See you in the next video.